family does in Arizona. So welcome. Good morning, bright sunshine, bright-eyed, bushy-tailed Tony Rago. So it's great to have you here with me. We're going to talk about a number of things today. We're going to talk about manufacturing data, precious metals, trading futures. Of course, as always, we will talk about some bulls and some bears and some potential setups. And we will probably have to let Tony leave a minute or so early so he can go launch the futures room. And futures room, they're even asking you already, what time does the futures room start every day? Tony, what time does futures room start?
I typically start with some music right at 9 a.m. So right
Okay.
around 9 a.m., we get about 20 minutes of a playlist for and we rotate through different playlists. We make it fun. And then I go live right around 5 till the open.
So 9 a.m. Eastern. Today, there might not be as much music. We'll see if he tries to launch that while we're talking about a couple things he's going to do here. But that's generally the time he gets going. And to your left, if you can see this page, you'll see over on the left, you'll see the futures chat room, Theo Futures chat room. That's where that will be at. So Theo Trade Live, you can do it from the main room or you can do it here. All right, let's talk a little bit about economic data and some manufacturing data that came out this week. And so to look at the manufacturing data that came out this week, we want to make sure that we're looking at the Philly Fed manufacturing, the Empire State manufacturing data. And I'm just going to dig a little bit into that before we go into the details. But if we look at this, I thought this was interesting. We'll use part of this with Tony in a minute. But you'll notice we've got Empire State Manufacturing Index that came out better than expected. But the trend of this, and I'll show you, we get into the nitty gritty here in a minute. The trend of this is overall down. We're seeing a slowdown in manufacturing, even in the Empire State data, even though it outperformed expectations. And then we scroll down here and we see Philly Fed manufacturing. Huge miss. We went from 44% down to 18%. Now, some manufacturing data, like today's manufacturing purchasing managers index, is a scale from 0 to 100. Anything over 50 is considered expansionary, and it means that we're going to have growth and expansion in the manufacturing data. Anything below 50 is considered contraction. But the Philly Fed goes negative. So it goes negative 100 to positive 100. So they don't all track the same thing. The manufacturing data in Empire State manufacturing goes the same way, negative 100 to positive 100. So you can go negative on the Empire State manufacturing. You can go negative on the Philly Fed, but Flash manufacturing PMI and services PMI is a scale from 0 to 100. Super confusing. I know it's bureaucracy at its best. It's when you have government decide how they're going to run their surveys, and one person said, "Well, let's show it as a percentage." And I have no problem with that. This is saying, let's just show it as a number on a 0 to 100, and it doesn't show you growth or contraction as a percentage. It's just a scale, and so kind of ridiculous. Anyway, that's how the government works. So as we're looking at that, we can see some of the manufacturing data. We're going to dig a little bit deeper, but I did find it interesting on this, just on this page of US data that's highly important or impactful to the economy and the US dollar, that you'll notice Trump speaks, Trump speaks, Trump speaks, Trump speaks. We didn't have this for the last 4 years. We didn't even have this in this previous setup. They did not put Trump speaks 5 times a week in
Nope.
the data in the calendar. Now we have it in the calendar as a highly impactful data point. This is insane. Tony, how are you
Yeah, I
dealing
mean,
with that?
you remember in the first administration, 2016, that we didn't have any heads up at all.
Yeah.
This is as much
Tweet.
of a heads up as you can get. You know he's going to be speaking every day, but yeah, it was never on the schedule. So
Yeah, and it shows there's a lot of importance being placed on these comments, on his executive actions and orders. So it's interesting, and it's certainly creating a new dynamic. And I will tell you that it's certainly adding some interesting changes to the way I'm approaching this market. So and we'll dig into that again here in just a minute. Let me just show you some quick details on Philly Fed manufacturing that will lead us into some other manufacturing data in one moment. As we're looking at this, here's the Philly Fed, and I want you to see not just the that we missed, but this pattern. The pattern in the data that goes into manufacturing was, we look at this, we went super negative. I commented on this in Thursday's video. If you want to go back and watch Thursday's video, we dig into a little bit deeper. I will give you more stocks to look at in Philly Fed manufacturing or manufacturing in general, if you want to go back and watch Thursday's afternoon video. But the main thing I want you to note is that we spiked up super high and then we've adjusted way back to the next month. There's a major miss. This is likely a false tick because, or false data point, because we don't see suddenly a huge increase, 50% year over year increase, and then all the way back to 18% without it being a miss. And it's probably going to be more something like this, where we're going to putter around here for 1 or 2 months and then drop back negative based on those patterns. It's not great. It's not a good sign to see it spike up and then decline that fast. And we can look at the same thing in the Empire State, that we've been negative really since 2022. The majority of the time since 2022 has been negative. So we've got positive, negative, positive, and this positive is lower than the previous one. It could easily go back negative. It's showing a major slowdown in trend in manufacturing. The best I could give you is some consolidation in that they're hopeful and that the people expanded their positions. PMI today could help clarify that. And the reason why we look at PMI is Purchasing Managers Index. I want you to think of it this way. I'm going to give you a quick business cycle rotation picture. Manufacturers don't make stuff just because they want to make stuff. Manufacturers are supposed to be making stuff to the demand of the populace, the demand of the consumer, whether the consumer for them is a business, a farm, a mine, or just, it could be your Crocs. The manufacturers are not going to make that product unless there's demand for that product. And so when you look at the PMI, the Purchasing Managers Index, this is the managers that buy the stuff to make the stuff that you are going to buy from them. So they're not going to buy a bunch of raw goods. They're not going to buy a bunch of components to make your thing that you want to buy from them unless they see the demand holding or rising. And so this manufacturing index can be something that can confirm what we're seeing through here. The Philly Fed and the Empire State is more specific to kind of the metals, the minings, the big operations that are more industrial type of things. And so, and US specific industrial type things, well, this one can be a lot more inclusive. So we're going to see a little bit of data come out of there. And it's the reason why they focus so big on manufacturing during the elections and in Philadelphia is because manufacturing jobs are still significant. The US is the #1 manufacturer in the world. It is not China. When it comes to mass production, it is the US. Now, it's partly because we also include technology in that. So we're still the #1 manufacturer, and it's dollar amount. So you manufacture a cell phone, a lot more expensive than when you're manufacturing the little things on Temu. So, and then plus Tony's laughing at it. I don't know if Temu manufactures identity theft anyway. So that's a different thing entirely.
Slightly.
So manufacturing is going to be pretty significant. It's one of the earliest movements in the cog of the economy. And so we're looking at this PMI as an early indication. I will come back and we'll share some stocks that could be of interest here when we get to the bulls and bears. But it's something important because as we're looking at this, if we're going to see growth and if we're going to see demand, and if it does accelerate to the upside, it's going to have some real impact on overall demand for basic materials and metals. So what we're watching as well is we're watching metals for two reasons. One is to see if Dr. Copper is still on the rise and whether gold and silver are going to continue to move. So as we're looking at this, we talk about precious metals. We're going to go into the discussion of what about gold reaching its record high. So let's talk about precious metals. Anyone, and this is a question for all of you, not just Tony. Anyone watching gold reaching record highs and wondering, is this time to buy gold or is this time to sell gold at record highs? What do you think? Are you Schmiegel?
At record highs? I mean, you know how I trade. Probably not.
It's hard to buy record highs, isn't it?
It's hard to buy record highs. It actually absolutely is. There's just too much historical data that, we kind of get these little, bursts through the all-time high or a record high, and we start to see a rotation back the other way. I'm sure that it's the same for precious metals as well. I'm not a big gold trader, but just on the outset, I would say it's a fade.
It's a fade. So Tony, you're saying that if you can't just walk into Mordor, but if you did walk into Mordor and the ring's going off the edge of the cliff. You're saying record highs. You're not diving for the ring and grasping it and falling back into the lava like poor Schmiegel did.
No,
At record highs, you're not making that leap. That's what you're saying.
I am not.
All right, let me
Sounds
show you.
like it sounds like you're baiting me. So,
No, 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 no. I'm not. I'm not kidding.
so you're going to show me a chart that says if you bought the record highs.
Now, let me pause there on stocks alone. If you bought the record highs on the NASDAQ, and we're going to come back into some details for Tony on the NASDAQ. If you bought the record highs on the NASDAQ, how would you perform versus shorting the record highs on the NASDAQ?
Yeah.
So the data shows that if you bought every new 52-week high versus selling. Now, I think this is a very conflicting comment because it's not a one or the other. It's not binary here. You can say, I'm not going to buy the record highs. I'm going to wait for a pullback and then buy a bounce, certainly. But they said if you simply bought the 52-week highs, and this is from Harvard, bought the 52-week highs of any of the major indexes or sold the 52 highs. So they gave a binary choice, sell the new highs or buy the new highs. You outperform 80% on buying new highs, but it's not a binary choice. If it reached a new 52-week high, there's nothing wrong with saying let it breathe out and let it go back, do a swing high and play back to the previous high. So I don't like that choice. I think it's a false paradox, I guess, when you're looking at that, or false equivalence there, because you can wait for it to pull back. There's other things we do, and we trade through, and we trade back to, and we trade a bounce up, and there's lots of things we can do, and we'll do those with Tony in a minute. But as we're looking at this, let me give you a chart. Whoa, that's not what I want. Started playing in my ear. Let's go back here and TS asked the question, is the Philly Fed manufacturing the hub of the US? It's kind of the metals manufacturing area of the hub of the US. So there's a lot, I mean, you got to remember that big steel production was back there. And so we did a lot, and it's still fairly large. It's just, doesn't have the same weight as it once did. Where is my chart, Tony? It disappeared. All right, here, I'm just going to grab a new one. New chart, because that one disappeared. All right, so as we're going through here, I'm going to throw gold on here because this is a record high in gold futures. There we go. Record high yesterday. Just touched it and came back down. Now, for me, I'm with Tony 1,000%. These new 50, this is a new 52-week. Let me go back. New 52-week high, new 52-week high, new 52, new. So you had 7 different times it said, if you're buying 52-week highs, here's where you'd have bought. And you would be up a little bit after 7 attempts. I wouldn't say that's a great strategy. I'd say if you're seeing it test it and pull back, can we buy these bounces? Can we buy the pullback and the return? So again, I think it's a false concept of saying you always buy the 52-week highs. It's always going to outperform. No, that's if you only can choose to be long or short. I can choose to wait. I can absolutely choose to wait. But this is the chart I wanted to show you. Gold versus silver. And silver, not its 52-week high. So the question is not necessarily do I buy gold? The question is, do I buy silver? Do I fade gold, buy silver? Do I fade them both if they both fail? Is gold and silver the comparison what it once was? So I'm going to put in here a price ratio really quick. And this is the indicator here in Thinkorswim. There's lots of people that do it. This is the price ratio. We're going to put in GLD as the first one. And we're going to put in SP or SLV as the second one. So I'm using the ETFs. You do not need to trade the futures in this pair. You can absolutely trade the ETFs. The ETFs try to track as closely as we can the prices, underlying prices of the spot futures. So they do a pretty decent job, and it allows you to do this in about any type of trading account you want, or a retirement account. So what I want you to note is where we're at. This is gold versus silver. And as we look at this, gold is making new record highs, but notice the ratio. The ratio is kind of stuck here. Gold and silver are moving along. So as we're stuck near these highs, it's not just the high, it's the high of the last year. It's not just the high right now and of the last year, it's the high, it's the high, it's the high, it's the high. The ratio are kind of at their peaks. So if gold is at a peak ratio versus silver, you have one of two choices if this ratio comparison, this top edge of the comparison, is going to confirm. And you can see June through here again and again and again and again and again. We've done this about 9 times in the last 3 years. If we're at the top ratio, if gold is up here and 52-week highs and the silver and gold ratios here, I mean, the gold is at its peak compared to silver, we have one of two choices. If it's going to maintain, either gold has to pull back or silver has to rally. That's it for this to maintain. And if it does it dramatically, then this pulls back aggressively, and that could be gold falling and silver climbing, or it could be gold just falling or silver just climbing aggressively to get these ratios to continue in this pattern of this extreme edge, top and bottom. And so seeing that we're at a 9 times ratio, and let me know if in the comments, let me know if there's a question about this. I'm simply saying that it takes 9 times the amount of silver in the ETF to buy gold. Now this is GLD. Go ahead, Tony, what was that?
That's what that's surprising to me.
Well, and it's not 9 times, it's really 90 times because it's GLD is it's a 1/10. So, but it's surprising the pattern or surprising the ratio?
No, the ratio, yeah.
Okay, yeah. So it's really 90 times because GLD is a 270.
Right.
Yeah. So, and I thought that as I said it, I was like, we're gonna miss some people here on that ratio. But GLD to SLV is 9 times. So GC futures are probably 90 times roughly.
Okay.
And so, yeah, so that ratio there is more the pattern in the ratio. 1/10. So silver, it takes 9 ounces of silver to buy 1/10 of an ounce of gold, or 90 ounces of silver to buy 1 ounce of gold, is what that chart is telling you. So there's still more important about the ratio. I want you to focus on that ratio for just a minute, because I also want you to know something else is happening. If we go back through here and look at these spikes, not all of them, not all of them, but if we look at those spikes, that's February, that's February, that's February. Coincidence? At some point, a repeat happening over and over and over ends up, excuse me, where it cannot be a coincidence. And so as we're looking at this, what I want to know is what happened this February, what happened this February, so we can know what could happen this February. Did gold move down? Did silver move up? And we can even go back to July and say, okay, look, when it's peaked past, gold started selling off. That means gold fell faster than silver through here. Right through here, gold stopped moving. It traded flat. This is a weekly chart. It traded flat for about 15 weeks, and that means silver climbed if the ratio corrects like this. Back here, gold got to this level, and then gold accelerated. But even here, that means gold accelerated, but silver accelerated faster. And so you cannot have this ratio pull back. Your choice has been gold down, gold flat, silver up, gold flat, silver up, gold up, silver up faster. And over here at the current price, if gold is up, unless you think gold's going to accelerate faster, that means silver has to accelerate even faster than that. And so to me, the opportunity, if you're going to see this breakout of the 52-week high, it says buy silver. Unless the gold's going to go into a holding pattern and silver is going to slowly climb, if this ratio, this pattern continues, this is a call to buy silver and hold gold, or short gold and don't short silver, because silver could still climb. It can take a couple months or a couple of weeks for this to play out. It can stay here at these highs. So for me, the opportunity is not necessarily flat out buy gold. It could be hold gold, sell silver, sell calls on gold, trade options on gold. And Brandon has some really great stuff he can talk to you about as far as option strategies and some option signals he's getting on this. So definitely join Brandon later on today. Now, I'm just going to take a few seconds. Sorry, I've got a little cough here. I'm going to just take a few seconds to talk about gold versus Bitcoin. I'm not going to take much time because I hate Bitcoin and I think it's garbage. Trade it. Don't own it. Don't hold it. Trade it. This chart, if you look at this from going all the way back to November, this is a weekly chart, Bitcoin's stuck. So look at this flatness in here and look at the pattern to tell you that I want to sell highs, buy lows, sell highs, buy lows. Right now we're bouncing up. This week could close positive because we're setting up for that right now. Let me get rid of my monkey bars. We're still overbought for the month. We still haven't broke through the zero for the last 3 weeks on the monkey bars. And we're holding it fair price for the year. This gray area is fair price for the year. The zero line is the month, which we're coming down to last week. But all 3 weeks, notice, overbought 50%, overbought dropped and dropped about $6,000 at some point. And then we're up here again, overbought, and we haven't crossed the zero. This is not necessarily a buy signal for Bitcoin. It's stuck at fair price for the year, and it's overbought for the month. And so if you see it pull back lower and you can get an opportunity to buy it closer to that fair price, just be aware that we're stuck in this range and have been since November. Buy the lows, sell the highs. This is not a time to hold on to these things. And when we look at this, I don't think most people are willing to tolerate a 6,000 and 7,000 point move, let alone a move that takes you from 111,000 down to 93,000.
You
That's a
think we're
major
still,
pullback.
you think we're still correlated? You think Bitcoin, if is there any correlation to our equities market?
I still think the only correlation is risk, volatility and risk. I've never thought it was correlated to currencies. I've never thought it's not a currency. I will stand that ground. That's a hill I'll die on. It is not a currency. And and maybe in the future it will be, but it just currently is not. And the correlation is pure, in my view, is purely volatility. And again, it's not opinion. And let me explain why I say that's not opinion. It's math for me. If we take the correlation study, just tell me, is it correlated or not? Here's the SPX and say, show me the SPX. And we could try to say that it goes back and forth off of the zero app. And this correlation study, for those of you that are not familiar with it, we go from zero to one to -1. And what it does is say if they're perfectly correlated, one, it'd be a one. If they're inversely correlated, so one goes up and one goes down, the exact same measurement, their ratios, then you'd go -1. And you can see this, we're crossing back and forth. We're below the zero line. So theoretically, currently, we're inversely correlated and have been for the last 2 weeks. And we got fairly positive correlated over here. You zoom all the way over here, and you can see lots of inverse correlation through June, July, August. I don't think that's a very good correlation study. It doesn't track each other. If I showed you something like well, I'll show you in just 1 second. But if I go and look at the VIX, I think this is a better correlation as far as risk on, risk off. And I've got this marked so you can see the inverse correlation is 1 and -1 again. So we'd say if the volatility is high, we're not buyers of Bitcoin. And we look at how long we stay in there. And I think your better opportunity is when you see it break out of that volatility and come back in the negative, that they're getting back to their correlated behaviors. And so when the volatility is high or rising, people are selling Bitcoin, and that's what creates that inverse correlation. If volatility is low, they're emboldened and are willing to take risk and buy Bitcoin. So it's just, for me, it's just more math than it is love or hate of Bitcoin. It's a risk on asset, but
Yeah.
so is equities, just not the same correlation.
Trade it.
Yeah, trade it. That's like I said at the beginning, just trade it. Trade it, trade it, trade it. So as we're looking at all these things, when you say just trade it, Tony is the king of the NASDAQians, as has been said. He is their leader.
The NASDAQians.
And you look at this, since I've got the correlation up, look at the VIX correlation, inverse correlation to the NASDAQ. It's even stronger than Bitcoin. So I would say instead of trading Bitcoin, trade the NASDAQ. Your correlations, your math is better if you just follow your rules and pay
Exactly.
attention to what the math says. The VIX compared to the NASDAQ is a better correlation, inverse correlation to the volatility than the other. But we've had a lot of volatility. What are you doing with the NASDAQ with all this volatility, Tony?
Well, it's creating a lot of opportunity in the setups that we focus on. I've right now, obviously, we're getting ready, gearing up for another 90-day trader challenge with the golden setup. And in that challenge, what I have traders doing is focusing only on 2 levels. Okay, only 2 levels. And so just on the outset, you could say, well, that's not going to be a lot of trades for the day. They're not going to set up very often, but in the volatility, we are seeing the frequency of that setting up over and over again. And then, of course, like we were talking earlier about Trump, with him being very active in the news cycle, we're seeing even more volatility and activity in the NASDAQ. It is absolutely it's very volatile right now, and it's providing a lot of opportunity. In all intraday, of course. I don't really hold this stuff overnight. So the moves that are happening, are allowing us to get our day done. As my methodology is hitting a daily goal every single day, and we're able to do that, ideally before lunch. So it is creating more frequency for us NASDAQians, for us NASDAQ traders.
Well, and I actually noted that just last week, because I always try to come on about 5-10 minutes before and just listen to you while you're wrapping up your session. And you had, you like I said, you sometimes get two sessions or two or signals in a single session. You got 3 or 4
Right.
in the 10 minutes while I was just waiting to take over the future term.
Yeah.
So in a 10-minute time window, you got 4 back throughs on a 26.
Well,
And
like you said earlier, it's just math. And everybody kind of always says, why the 26? Why the 26? It's without getting too granular with it, it is math. It's math. It's a midpoint in how the NASDAQ trades around inflection points. So it is literally a midpoint coming off of an inflection point, and we dance around those inflection points a lot because that's where the moves happen from. And the 26 is just sitting right there, ready to play.
this was just yesterday. Just
Yeah.
so you can see it, 26, 26, 26, 26, 26, 26, 26, 26, 26. It was a
Yeah.
beautiful, beautiful setup
And
yesterday.
the move came off of that, right?
Yeah.
So we had a very large pullback, I thought it was going to really kick off a decent down move, like the beginning of a 5%, 6% pullback. But here we are back into the zone. But it is you see it on the screen. This is how the 26 acts. It can kind of be the low that holds. And what are we? 200 handles off of that,
Mhm.
right?
Yeah, and we're setting up for
And
a different 26 this morning.
multiple opportunities around the 26. We're at the 26 right now. And
Yeah.
so in the 90-day trader challenge, we trade the 26 a couple ways, right? It's not always just a long. We saw a return to the 26 from below, which also is a setup that I teach. I dub that one a silver setup, but it's utilizing the same level, just albeit on a different directional type of trade. And they can be fantastic trades too. So we come down into the 26 from above. It's a huge level of support. Obviously, if we test it over and over again, it will break. And then we can see it start to turn to resistance. But what is cool about the NASDAQ is that it travels. So we'll have 200, 300, 400 range days. And within that, we're seeing multiple 26s at different, tranches of price. So in other words, like right now we're at 22,226. We're probably going to see a 326 or a 126 today. Um, maybe we'll hang right here and the move will start from here. We're opening in 14 minutes, so I would assume that this is where we're going to start our move.
Yeah. And right now it seems to be the lift. Who knows? But like you said, you got 100 points in there potentially.
Yeah, and we've got econ this morning. I call our morning data, so PMI. I call that econ. A lot of
Hmm.
my traders know that, and that could start to set up the move too. So that's the cool thing about trading the Nasdaq. We don't have to rush in and trade it right at the bell, right at the opening bell. We can actually wait 30 minutes, and the volatility just creates opportunity every single day, over and over again. So the pattern for the 26, if you guys haven't been around long enough, is when we come from a specific inflection point down into the 26, it is a buy. What's funny is the more traders that I teach this to, Have you, and I know you teach a lot of traders too, so do you come across a lot of students that are directionally biased? Like, I can't short, I can only buy, I can
Yes.
only buy.
And I think I don't think it's limited to traders. I think we all have biases, not really prejudice, because you're prejudging. You've already determined what it's supposed to be. It is. I want people to think of it like that. It's a prejudice, not just a bias.
Yeah.
It and prejudice hurts people. Sometimes you.
Oh yeah. Yeah. I mean, I try not to be. It's so hard not to come in with a bias. But we don't trade our feelings. We trade what's in front of us. And
That's
price
right.
action is rules everything.
We eat our feelings, but we don't trade them. Yeah.
Exactly.
No, I think it's fantastic, and I think that one of the things I love about yours is it truly does say, no, we don't do this because of our biases or what we think is going to happen. It's going to do this. It's going to do this. I don't know if you caught this, but I called it putting on the Rago, because in Young Frankenstein, I'm the Gene Wilder curly hair little guy that dances around, and you might think that Tony, that Tony's just NASDAQ, just NASDAQ. It's the one trick pony, as he even comments. And it's like he Rago is standing there, but they all came to see Rago, right? They didn't come to see Gene Wilder. They didn't come to see Dr. Frankenstein. They came to see the monster. And it may be a one trick pony. He says putting on the Ritz, but it really is putting on 26. It is doing this over and over and over again. And what I love about it is so repeatable. And regardless of the repetition and the repeatable nature of it, your ratios and your probabilities, there is a solid edge in there,
Yeah.
because statistics say probabilities and ratios are going to line up. You're looking for that edge, and great traders are 3% edge. And I don't have the math behind yours, but it seems to be double or triple that as far as the reward to risk versus that number. And so I love that setup. I love the fact that it's consistent and tradable every single morning.
Yep.
So I'm going to, because we're running down on time, this is when Don starts knocking on my door here and says, hey, we got to wrap up. I'm not going to be able to go through all the bulls and bears. I'm just going to give you the list. I'm bullish XOM, J&J, MO, and Rio. So we're looking at various stocks in energy, healthcare, and mining. And I'm also looking to be bearish in the industrials. Go back and watch Thursday's video on that as far as Boeing, General Dynamic, Caterpillar. I think those are some pretty decent setups to go short in there. And in the end, certainly join Tony and I in the futures room. We'll be there. Tony's going to be there here in minutes and seconds, and he's going to be jumping over there, and he can answer further questions there as far as the setup. But today, be aware again, there's econ coming up, PMI, that's going to confirm the stuff that I talked about at the start today, but also something to add volatility and maybe some opportunities in the setup, even if we ride out and wait till after the econ. Hopefully it'll kick in some extra volatility. Any parting words and comments about the Trump effect? I know that you've changed and shifted little things to include that into your analysis. What's it
Yeah.
doing for you?
I mean, again, just creating more opportunity, more volatility. There is a point of diminishing returns, obviously. When we typically will see the move and then we'll see what was actually said. So what's very important in that regard is do not try to game the move. Let the move happen, let price settle, and then look for our setup. But the result of the move has been yielding us more opportunity for the levels that we're trading.
Yeah, and I think that's the game, because we sat so tight for a while. I think it's great. Volatility is a good thing if we're prepared, if we know our rules and know our game plan.
Rules and structure, 100%. Absolutely.
Yeah. Hey, thanks for joining me this morning, Tony. I
Thanks for having me.
appreciate it. Yeah, and join Tony here in just a minute. He'll be in the futures room. I'll be in the futures room right after him and back later on to talk some long-term trades. Don is coming up here in the main room, and Tony in the futures room. And that's how we're going to start our day. So have a fantastic day, everybody. A fantastic end of the week. And we'll see you on Monday if we don't see you before then. Have a fantastic day.